Hi, I'm Matt Bell of mattaboutmoney.com. I'm talking today with Mark Biller, executive editor of the Sound Mind Investing newsletter. Mark, the stock market has been on a wild ride, to say the least, over the last few years. So what do you say to people who've become scared of investing?
I guess I would just encourage people that the idea that the stock market used to be a tamer place is somewhat of a rosy ideal, kind of like we tend to think back to the 50s and say everything was great back then and now it's terrible. Well, it's kind of the same thing with the stock market. If you really step back from the situation and think back, you can go decade by decade and pretty much see huge potential issues that were facing that generation of investors. Think about being an investor in 1932. You're right in the middle of the Great Depression. Go to 1942, you got a world war going on. I mean, it kind of makes today's problems pale by comparison. Even in the 50s, we're buying bomb shelters here. In 62, you've got the Cuban Missile Crisis. You've got Vietnam right around the corner. In 72, you've got gas station lines stretching miles long because we've got an embargo. 82, everybody's convinced, our reign is over. Now it's going to be the Japanese century coming up. So at each phase, you've got these big issues. So the idea that today we've got the worst ever situation, probably not the case. Now, that's not to say it hasn't been volatile and scary, and that's where having a solid long-term perspective and a long-term plan really will make the difference between you bailing out at the worst possible moments or being able to stick with a long-term investing strategy and actually make it through okay.
You offer subscribers to your monthly newsletter two core investment strategies. The first one is called Just the Basics. Can you tell me a little bit about that?
Just the Basics uses either 3 or 4 index funds. You're just trying to match segments of the market. We combine these 3 or 4 index funds, and you just set your course at the beginning of the year with those index funds and then walk away for a year until it's time to do rebalancing. And then you'll do an annual rebalancing, but with only 3 or 4 funds, that takes you probably 10, 15 minutes, and then you're done for another year.
SMI's other strategy is called fund upgrading, which is a more active approach to investing. Tell me a little bit about how that works.
What all of us have always heard is find a good manager, stick with them through thick and thin, and over time, those good periods and bad periods will kind of even out and average out, and you'll do okay. Well, that's one approach, but what we do with upgrading is instead of kind of that marathon runner idea, we're doing more of a relay race. So we've got formulas that help us see, okay, who's in sync with the market right now? And we're going to be in those funds. And then as they get out of sync, we're going to upgrade into new funds with managers who are in sync right now.
In essence, fund upgrading follows what's known as a momentum investing strategy, right? Where you're looking at funds and recommending those that have been doing well in the recent past.
Absolutely, Matt, you're right. It is a momentum strategy. It's a trend following strategy. And momentum is basically the idea that short-term performance, short-term past performance over the last year has been shown in a number of studies to be predictive of short-term future performance. What we always hear is that past performance is no guarantee of future returns. And of course, that's true. We've also heard many, many times that you can't look at the funds that have done well in the past to predict which funds are going to do well in the future. And that's where we have a little bit of an issue with what's commonly told to investors, because that is absolutely true over longer time periods, 5 years, 10 years, no correlation between the last 5 years winners and the next 5 years winners. But there have been a number of studies that have shown pretty conclusively that the winners over the past year, that performance does tend to persist over the next 12 months or less. Now you go outside 12 months and it disappears. So this upgrading idea, we're looking at performance from the last the last year, different intervals over the last year, and then we're trying to ride that performance, that momentum into the future to capture that little bit of extra return, and hopefully over time that little bit of extra can give us a real edge over the market.
A pretty common bit of advice for investors is that you can't time the market, but is this a market timing strategy?
Well, it isn't, because we're not making a call on whether the market is going to do well or not. We're staying fully invested in the market. We're just moving from fund A to fund B. Market timing typically is when people are looking at market fundamentals or whatever they're looking at and saying, okay, things are getting bad, I'm going to take my money out of the market. And we're never doing that. We're not trying to make those kind of predictive calls. We're just following where the market's going, but we're staying in the market.
It sounds like with momentum investing, you're following a very objective process.
Our part of it is very mechanical. We're using formulas, we're ranking these funds. There's no emotion to it. We don't really care who's managing the fund or really even how they're managing the fund. It's a very quantitative driven process for us.
Have you seen any differences in the results that momentum investing typically achieves between bear markets and bull markets?
Well, it's an interesting question. And over the last 12 years or so, we've seen a couple of bear markets, a couple of big ones. In this most recent one, the 2008 financial crisis, momentum didn't help at all. The market went down so fast. Really very few strategies held up in that kind of a downdraft. And in fact, 2008 was the only year in the last 12 years that our upgrading strategy has trailed the market. It was about a point and a half below, minus 37 point something to minus 38 point something, which when you get to those kind of losses, I don't know that a point here or there really matters too much. But so the point of all of that is just that in 2008, upgrading momentum didn't help you at all. Now, in the slower, more prolonged bear market that we had from 2000 to 2002, upgrading helped a lot. During that bear market, like in 2000, the market lost a little less than 11%, upgrading lost a little less than 3%. 2001, the market was down another 11%, upgrading actually gained almost 5%. And then 2002, the market was down 21%, and upgrading was down about 14%. So it really took the edge off of that bear market. So we've seen it go both ways. Upgrading's not a silver bullet. We recognize that. Our readers recognize that. It's not going to always add tremendous value. But it's kind of the idea that by hitting singles every year, you can score a bunch of runs. Every now and then we'll hit a home run, and that's great. We love home runs. But, we're content to take singles over time because, I'm looking at our performance history over the last 12 years where we've trailed the market 1 year out of that. And cumulatively, the market is up about 41%. From the beginning of 99 to the end of 2010, the market gained 41%. Upgrading gained 185%. So, if you're content to let the process work and let those gains accumulate, and you can discipline yourself to not bail when things look rocky and when you're scared, you can string these singles into some really impressive runs, to continue that baseball analogy. So it's worked pretty well for our folks over time.
It's obvious from your website that you're a Christian organization. You have lots of articles about faith and finance, and yet you don't screen your investment recommendations. You don't screen out companies or mutual funds that are involved in industries that some Christians may have issues with, an approach to investing called biblically responsible investing, or BRI. Why don't you follow a BRI strategy?
The biggest issue for us is just simply that we've identified a strategy, a way to go about investing that involves fishing from a very broad pool of mutual funds. And if there were, say, several hundred of these BRI funds or, thousands of options there, then it might be feasible for us to say, you know what, let's try applying this momentum approach to those funds. Unfortunately, there isn't. There are a handful of real good options there in that BRI space, but it's not something that we can do with our approach. Each person really needs to decide, if I buy an S&P 500 index fund trying to track the market, and that happens to contain some things that I would not buy individually, is that too much for me? And some people might say, yeah, it is. I don't want any piece of that. I don't want any of it. But a lot of people would say, you know what? I'm okay if there's a little bit of that in there. I'm not trying to support that. That money really is not going to that company at this point. It's being traded in the stock market in these shares that are trading between investors. And so I'm not gonna limit myself dramatically based on essentially incidental contact.
All right, Mark, thanks so much for making the time. I really appreciate it.
Absolutely. My pleasure, Matt.
I've been talking with Mark Biller, executive editor of the Sound Mind Investing newsletter. You can find out more about SMI at its website, soundmindinvesting.com, or on my site, mattaboutmoney.com. I'm Matt Bell. Thanks for joining me.